What is going on, traders? As you can see, I'm off to work after this. On a more serious note, the Fed actually had an emergency meeting today. It is something we have to talk about. This is not unprecedented. We've actually seen this right around the time that the Fed first raised rates after the financial crisis of 2008. In 2015, they had an emergency closed-door meeting, very similar to the one that they had today. So I'm going to tell you what came after that and what I'm expecting for the market as a conclusion to that meeting. I'm also going to go over some eye-popping macro charts and tell you why I think a lot of capitulation in the market already has happened. For those that are new to the markets, capitulation really just means when folks give up and start selling all of their assets, which usually means that we are near a bottom. Now, please, caveat, I'm not saying this is the bottom, but there is a lot of data concerning capitulation that a lot of it has already happened. So just a little bit in terms of what's going on in the markets right now, then we'll get to the emergency Fed meeting and what they could have possibly discussed in there and what that means for the market going forward. I tweeted back on, when was this? February 2nd. I said that the SPY is notoriously known for W-shaped pullbacks and corrections. And I pointed out all of the times that we've seen W-shaped pullbacks and corrections just since the Rona crash. But obviously it has been happening even before then. But it has happened so many times. And we were on the verge of one after the SPY hit the 300-day moving average, hitting official correction territory for the first time since the Rona 2020 drop. And if you look at the SPY right now, it looks like a W-shaped correction is, as a matter of fact, in formation. Thank God for hedges, by the way. Back on February 7th, we opened up a hedge on the SPY. For this exact reason and the fact that the VIX was sky high, we opened up a hedge on the SPY that we are currently up 68% on. By the way, if you guys want access to all of our hedges, plays, long-term, short-term, options, day trades, etc., link is in the description below. Would love to have you. But for all intents and purposes, it looks like we are already in that W formation on the SPY. I am going to be looking at the 420 at the 420 level intently if we get there, because to me, that is where the major support is, going all the way back to summer of last year. And if we break this 420 support, then we will break this current structure and we will have to look at a potentially different formation. Now, I think a lot of selling has already taken place. If you look at macro charts, by the way, follow macro charts on Twitter. If you're into the markets, into charting, technical analysis, long-term trends, this is, in my opinion, probably in the top 3 of best accounts on Twitter to follow. But if you look at the selling pressure here, this is what I was talking about with capitulation. This is record selling. Now, obviously, we've had record buying, so it goes hand in hand, but it's all relative, right? So this is a record selling level for the S&P 500, meaning more people capitulated and sold their stocks than ever before. And if you look at the net put value, meaning the number of puts that were bought either as a hedge or as just downright shorts, this is the highest net put value, tying it with what we saw in 2020 when everyone knew, especially insiders, knew that the Fed was going to crash, and also Fed members. Remember, there were Fed members that were actually charged with I don't know if they were charged, but they were accused of insider trading and were forced to step down. There were 2 at the beginning of this year. And the same volume of puts that we saw back after the financial crisis after 2009. So this means that insiders, retail traders alike as well, but mostly you don't get this kind of volume without insiders actually hedging or shorting this much, that they've already been shorting all along the way. You have that record capitulation that I just showed you. In my view, there aren't too many reasons for the stock market to fall into recession level territory besides inflation, which now ties into what the Fed potentially talked about in their emergency meeting today and what the underpinning theme is for 2022. If we cannot get inflation under control, then yes, you can expect a recession in the economy, which would also lead to a major stock market crash. But aside from inflation, if the Fed is able to keep inflation under control, then I think this is a buying opportunity on high quality stocks with robust balance sheets, low debt to equity ratios, good cash flows. Most of the shit stocks already tanked. Most of the meme stocks, high beta stocks all of the stocks that were kind of the hype stocks, right, from 2020 and 2021, they've all crashed 50, 60, 70, 80%. Just look at ARK's portfolio, or as we like to call them, Titanic. But the mega cap growth stocks that actually had record earnings, like if you look at Microsoft, these, yes, they dropped, a lot of them dropped, 15, 20%, but they are at buyable levels, especially considering the fact that these are the only stocks that can prove their worth through their earnings. At the end of the day, all investors want to see is, can these companies actually generate the earnings that they are expected to generate and grow at the levels that they are expected to grow? That's it. So in my view, you could be very selective about stocks to pick up here, making sure that you're only sticking to quality and only sticking to the major indices like the QQQ, which tracks the NASDAQ, or the SPY, which tracks the S&P. Okay, now inflation and Fed talk. What could the Fed have possibly discussed in their meeting today? Well, it's not a surprise. If you go back to 2015, they had a very similar emergency meeting before they announced a rate hike in the next period's FOMC, which was in December of 2015. And if you look at the CME Fed Watch tool, you could see now that a 50 to 75 basis point rate hike, meaning 0.5 or to 0.75% in the federal rate, is now a likelihood, 60% probable that a 0.5 to 0.75% rate hike is going to be in effect as of the next FOMC meeting on March 16th. Now, this comes as a surprise to absolutely nobody. And if you look here, here's the timeline of the expedited FOMC meeting. And then shortly after that, we had the Fed rate hikes. We have the expedited emergency Fed meeting today. And on March 16th, we will for sure get rate hikes. Mark my words. Now, what helped the market drop down even further on Friday was St. Louis Fed President Jim Bullard said that he supports a 1% Fed funds rate by the end of July. He stands alone on that. Nobody else supports him on this. And he actually walked back his comments a bit today on CNBC as of the time of this recording. He still said that he supported that 1% hike, but that he is just one man with an opinion, and the rest of the board members know what they're doing. And what eventually will happen is what everybody agrees to. So, that sort of spooked the market a little bit, but it's, I'm very skeptical that these things are sort of spontaneous. I think that a lot of this stuff is telegraphed. I think there are different Fed presidents for a reason, and they are able to speak their opinions to the media for a reason, because the Fed takes the reactions all across the board and then ends up making their decision based on the reaction of the markets and the economy. So with that said, you are seeing a lot of this priced in already, especially on the 2-year, which continues to go up, meaning there is a sell-off in the 2-year. It works like this. If you're expecting the Fed to raise rates soon, then why would you put your money in a short-term bond like a 2-year bond when you know that the rate is going to go up soon and you can get actually a better percentage for your money, right? So what happens is that 2-year bond starts selling off. When the 2-year bond sells off, then the rates go up to reflect what the market is expecting in terms of a rate hike from the Fed. So in very, very simple terms, if you're expecting the Fed rate hike to go up 0.5%, then the 2-year bond will start selling off until it goes up by the same rate. And then that is when when investors will start pouring back into bonds when they think that the rate is acceptable based on their expectation for what the Fed rate will be. Hopefully that makes sense. And one final note on rates is just know that these things are always in flux. What is expected never pans out. If you remember at the end of 2016, the Fed was saying that they see the rate to be around 1.375%. If you look at the history of the actual rate and go back to 2016, you'll see that it actually only ended up being, where's 2016? Sorry. By the end of 2016, you could see that the Fed funds rate was actually 0.75%. So about half of what the expectation was. And that is because these things are in flux. The markets are in flux. Inflation is in flux. So that's why we have these economic measures along the way to try and monitor what's going on in the economy. And then the Fed will adjust policy as they see fit. So because Jim Bullard ran his mouth and spooked the market with his desire to raise rates to 1%, the market is now pricing in a higher rate for February 16th, whereas before they thought it would be 25 to 50 basis points. Now they're like, oh, it might be actually closer to 50 to 75. And with that said, the bond market is pricing that in and the stock market is pricing that in. So aside from this geopolitical story here regarding Russia, Ukraine, the US, and the European powers, I don't think that there is more of a reason or a significant reason for the markets to tank, right? Now, I've talked about this before. I'm not going to include an in-depth analysis of the war and what it would do economically in this video. All I would say is that historically, the lead up to wars cause an initial shock to the market, right? Or can add to an initial shock to the market, but they end up being good, unfortunately, for the stock market. There is a concept called wartime economy for a reason, right? And it's because there's a phenomenon where the stock market actually goes up when the US is involved in conflict, as long as that conflict does not threaten the borders or the geography of the US itself. If it's somewhere, over there, then usually and unfortunately, the markets tend to go up during times of war. And the reason I say unfortunately is because obviously, you don't want war to be the reason that your portfolio moons, because people on the ground actually get affected by this. And governments rarely act in the interest of regular people, unfortunately. Rant over. But yes, if you want to learn how to trade options, how to hedge, what we're looking at long term, as I said, there are some buying opportunities right now, things that I will be looking at soon, because aside from the geopolitical conflict, I don't think there is a ton of reason, as long as inflation can be kept under control. I don't think that they're beyond the Fed rate hike, that there's more reason for the stock market to epically collapse. Obviously, I'm not a fortune teller. Obviously, inflation can get so out of hand that it causes economic distress and a recession. But to me, that is really the main threat. And beyond that, there isn't more of a threat that we can foresee, barring any black swan events. But the definition of a black swan is that we cannot foresee those events. Let me know in the comment section what you think. If you got anything out of this video, leave it a thumbs up. Subscribe to the channel. Come join the group if you want to engage with 4,000 traders talking all day, every day about the economy, stocks, crypto, options, the markets, etc. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.